Friends, welcome to Crash Batch. Today we are going to start the topic that is AMT, Alternative Minimum Tax. Very important topic for exam point of view is concerned. So as you are aware of this, MAT is applicable for companies and AMT is applicable for non-corporate SSEs. First let me brief about the MAT. So many companies, let us take Reliance Industries, they are getting the profit of 1 lakh crores and they are declaring the dividend among themselves. Okay, so they are very happy because they got huge profits as well as they declared the dividend. But as far as income tax is concerned, they offered 300 crore profit and they paid only 100 crore tax. Now tell me ma, whenever they really got the income of inflows of 1 lakh crore but they paid tax of 100 crore on the income of 300 crores. The point is as simple as that. These are the profits as per their Companies Act. These are the profits as per Income Tax Act, and this is the tax as per income tax provisions. So that means so many people, even though they are having huge revenue, that they are offering low tax, or they are offering some people nil tax, nil amount of tax. Or else I will take another example for better understanding purpose. ABC partnership form is there. The partnership form income, let us say 100 crores. But what happened? They have claimed 35 AD deductions. Okay, let us say 20 crore. So net profit is 80 crore. No other income. So other income is, for example, 0. Total is, gross total income is 80 crore. But what happened? They want to claim deduction under section 80 IA, IB, etc. Profit linked deduction, provided they are eligible. Imagine they are eligible. Let us say take that is 50 crore. And next one is 10 AA deduction they have claimed, that is 30 crore. Total income of the particular entity is ABC partnership form is total income is 0. Whenever total income is 0, total tax liability also 0. That means the partnership form is offering nil amount of tax. That means their tax liability is 0. Now, if every entity is doing like this, how Government of India run the show? How the Government of India will pay the amount to public or general public or poor people as a pension, or how they will run the social welfare schemes? For that purpose, they wanted to collect some amount of tax even though you are in tax bracket, 0 tax bracket. For that purpose, they introduced one concept called as alternative minimum tax. In short, it is known as AMT, alternative minimum tax. Friends, as you know, the topic called as MAT. MAT is applicable for corporate SC, whereas AMT is applicable for non-corporate SSEs. Let's start the topic. AMT applicable for all SSEs except companies. Now, the purpose of introduction of AMT is in order to collect the tax from low tax entities as well as nil tax entities. Okay, chalo. Next one. Next topic. How to collect the tax liability? Computation of tax liability. Friends, here and onwards, remember, if you are in practice or if you are in an exam hall immaterial, whenever the examiner asked you about the total income, some steps only applicable. If the examiner asked you to calculate tax liability of companies or tax liability of partnership firm or LLP, you have to do like this. First, I would like to do tax liability of company. For that purpose, step number 1, you have to calculate total income of company. Okay, chalo. Step number 2, tax liability of company on total income. This is the step number 2. Step number 3, compute book profit. 115 JB book profit you have to do. For that, specific procedure is there. Step number 4, compulsory you have to calculate MAT on this, MAT on book profit. After that, you have to pay the tax liability, right? How much you know? Higher. Very good. Higher of normal tax as well as MAT. I repeat, normal tax as well as MAT, whichever is higher you have to pay. In the same sense, the same way for non-corporate SSE also, you have to pay the steps, you have to pay the tax as for the following steps. So I would like to do the same computation for the partnership form. So non-corporate entity or else LLP, etc. First one, you have to calculate step number 1, total income. Step number 2, you have to calculate the tax on total income. Step number 3, compulsory you have to calculate adjusted total income. I repeat, adjusted total income you have to calculate. Step number 4, you have to calculate AMT on adjusted total income. That means alternative minimum tax. Step number 5, tax liability is equal higher of, I repeat, higher of normal tax or higher of AMT. Normal tax or AMT, whichever is higher only you have to do. So MAT applicable for corporate SCs, AMT applicable for non-corporate SCs. But here and onwards, when you heard the word compute the tax liability, get ready for 5 steps. Step number 1, total income. Step number 2, tax liability. Step number 3, adjusted total income. Step number 4, AMT. Step number 5, tax liability is equal higher of normal tax as well as AMT. So this is the way we need to compute the tax liability itself. Chalo, see the provision ma everybody in the class. Computation of tax liability of non-corporate SSE. First one, compute total income, compute tax liability, as well as compute adjusted total income, and compute AMT. AMT is equal adjusted total income into 18.5%. Next one is tax liability is nothing but higher of the following. One is normal tax liability and second one is alternative minimum tax. Okay, chalo. So there are total 5 steps. Next one, how to calculate total income, that is part and parcel of PGBP, capital gain, that is other sources, house property topic. And next one, how to calculate normal tax liability. So we have covered already this topic in basic concepts. And number 3, how to calculate adjusted total income we need to do right now. So adjusted total income computation. Friends, so many entities are claiming the deductions and offering less amount of tax. For that purpose, we have introduced the concept, Government of India has introduced the concept called as adjusted total income. For that purpose, first to take the total income as per normal provisions of Income Tax Act. First one, total income. After that, add the following deductions if you already claimed earlier. So if you have claimed the following deductions, compulsory we need to add it back. So first one is deduction under section 10AA. Friends, 10AA deduction is applicable only for those units which are located in SEZ area, special economic zone. If they do exports and if you bring the foreign remittances to India to the extent of foreign exchange profit or to the extent of export profit, they are eligible for deduction under section 10AA. Okay, chalo. Anyhow, that we will cover in the separate video section 10AA. But as of now, I am telling you, if any non-corporate entity has claimed 10AA deduction, I repeat 10AA deduction, the deduction must be added back. Okay, it should be added back. Students should get the doubt. Why we need to add it back this particular thing? Answer. SEZ profits are also subject to book profit, that is as per MAT. Same way, SEZ profits also subject to AMT. Even though it is deduction allowed while normal computation of tax, but while doing AMT computation, compulsory we need to calculate the alternative minimum tax on the profits of SEZ units. Therefore, deduction whatever you have claimed under section 10AA must be added back. Okay, it should be added back. Next one, deductions under section 80H2TT except ATP. First, to try to understand the logic behind this. Friends, deductions are as follows: 80C to 80U. Okay, out of that, certain deductions are relevant to expenditure based and certain deductions are relevant to income based and certain deductions are relevant to special character, that is physically handicapped or mentally retarded, etc. So there are 3 categories of deductions. One is expenditure based, second one is the income based, last one is the specific nature deduction. Okay, so first let me explain the deductions once so that we will come back. Okay, friends, now the deductions are as follows. First one is expenditure based deductions covered under section 80C to 80GGC, that is 80C, 80CCC, 80CCD, 80D, DD, DDB, 80E, 80EE, 80 G, GG, GGA, GGB, GGC. These are the sections. Whereas income based deductions are as follows. Friends, now income based deductions 80 IA, IB, IC, ID, IE, IAB, IAC, IBA, JJA, JJAA, LA, P, PA, QQB, RRB, TTA, TTB. But while computing AMT, that is while computing adjusted total income, If you have claimed the deduction under section 80H to TT, we need to add it back. For that purpose, I need to consider 80H is not here, right? So H not there. Next alphabet 80I. So IA series 2 up to I 80 IA to TT. So TT means up to TTA before that. That means 80 RRB. Up to that, I need to add it back. But no need to add back 80 capital P. So if you have taken deduction under section 10A, we should add it back. Same way, if you have taken deduction with respect to income based deductions 80 H to 80 TT, the same also should be added back. For that purpose, 80 IA, IB, IC, all the sections up to 80 RRB, if you have claimed earlier, to that extent, the deductions must be added back while computing adjusted total income. Okay, so see the provision ma. Deduction under section 10A, if you have claimed earlier, should be added back. Deduction under section 80 H to TT, if you have claimed earlier, should be added back, except 80 capital P. Same way, deduction under section 35 AD, if you have claimed earlier with respect to deduction for specific business, it also should be added back. So in PGBP chapter, we have claimed this one, that is section 35 AD. If you have claimed that kind of deduction, we need to add it back. But one thing for sure, generally deduction under section 35 AD is nothing but 100% of capital expenditure is allowed in those days. Whenever 100% of capital expenditure allowed, generally no depreciation also allowed in normal computation time itself. So today what happened, no, this 100% of whatever the deduction I have claimed, I am adding back. When I am adding back the 100% of capital expenditure, at least I need to give the deduction with respect to depreciation. So therefore, if you have added back the deduction under section 35 AD, then to that extent depreciation I need to deduct. See the word depreciation allowance as per section 32, assuming that deduction under section 35 AD was not allowed on the assets on which deduction under section 35 AD is claimed. So that means if you added back 35 AD in one particular computation, and automatically we have to deduct the depreciation on the particular expenditure itself. Okay, so one and only negative adjustment, all are positive adjustments. So after giving these positive and negative adjustments, you will give adjusted total income. Okay, chalo. Last time I'm giving the brief of the particular adjusted total income. See the adjusted total income computation. Friends, adjusted total income purpose, first we need to take the total income. After that we need to add deduction under section 80 IA to 80 RRB except 80P. So 80P you no need to add it back. Some people may have the doubt, sir, you only said 80H to 80TT. Sir, both are one and the same. The reason is, once upon a time 80H series deductions are there. Right now not there, but all the block is belonging to income based deduction. So ultimately you have to add it back 80H to TT, or else 80 IA to RRB, both are one and the same. But don't add it back, the deduction it related to cooperative society. Next one, we need to add it back deduction under section 10A, that is SEZ profits. And same way we need to add it back whatever the depreciation, whatever the deduction you have claimed under section 35 AD. And same way we need to give the deduction for depreciation under section 32. After adjusting all, I will get the adjusted total income. Chalo. So on the adjusted total income, I need to calculate tax liability, that is alternative minimum tax at the rate of 18.5% plus extra surcharge if any, plus health and education cess if any, all are applicable. So that is the way of computation of tax. Friends, so therefore tax liability of non-corporate assessee shall be computed as follows. Step number 1, total income. Step number 2, tax on the total income. Step number 3, adjusted total income. Step number 4, AMT on adjusted total income. Okay. After that, step number 5, net tax liability is equal to higher of normal tax liability as well as AMT. I repeat, higher of normal tax or AMT, we need to pay it as a tax. Okay, chalo. Now we can check applicability of AMT. Friends, AMT applicable to all SSEs being non-corporate. Only non-corporate SSEs only applicable. But in case of individual as well as HUF as well as AOP, BOI, AJP, it is applicable only if their adjusted total income exceeds 20 lakh. If it is less than 20 lakh or equivalent to 20 lakh, in this case, AMT provisions are not applicable for them. Okay, I will take one illustration. For example, in case of individual is adjusted total income, let us say 14 lakh 14. Answer, AMT provisions are not applicable. So, AMT provisions are applicable for individual, HUF, as well as AOP and BOI, and last but not least AJP, provided if their adjusted total income, first one is exceeds 20 lakh during the previous year. In this case, yes, AMT provisions are applicable. Suppose if it is not exceeding 20 lakhs, in this case the provisions of AMT are not at all applicable. Okay, chalo. And next one is as follows: the provisions of AMT applicable only if the SSE has claimed deduction under section 10AA as well as 35 AD and section deduction under section 80 IA to RRB. That means income based deductions, if you have claimed, then only it is applicable. Some SSEs have not claimed any of these deductions. In this case, there is no concept of AMT. So provisions of AMT is applicable to non-corporate SSEs, the two who have claimed deduction under section 10AA, if not 35 AD, if not 80 H2TT or else 80 IA to RRB, either way. But anyhow, ATP no need to take it, no need to consider while doing the provisions of AMT. Okay, with this we have completed the topic called as how to compute adjusted total income as well as how to compute AMT. So once again I am telling you, adjusted total income computation is as follows. First one, we need to take the total income plus we need to add it back if deduction anything claimed under section 10AA, and we need to add it back if any deduction is claimed under section 80 IA to 80 RRB. But if he has claimed any deduction under ATP, that no need to add it back. So except ATP, and also we need to add it back if any SSE has taken deduction under section 35 AD, that is a deduction for specific business, specified business. And if you have added back this kind of expenditure deduction 35 AD, then corresponding entry we need to do, that is nothing but depreciation under section 32 we need to provide. After that we will get the amount called as adjusted total income. Okay, chalo. Friends, if this adjusted total income exceeds 20 lakh, in that case only AMT provisions are applicable for individual, HUF, AOP, BY, AJP. Suppose if it does not exceeding 20 lakh, in that case AMT provisions are not applicable for individual, HUF, AOP, BY, AJP. Okay, chalo. But in case of partnership firm as well as in case of LLP, this condition, this restriction not applicable. By default, the provisions of AMT are applicable. So in case of firm as well as LLP, always AMT provisions are applicable in general. Okay, chalo. Friends, our next concept is section 115 JD AMT credit. So every non-corporate SSE has to pay the tax as for normal provisions or as for alternative minimum tax provisions, whichever is higher. For example, one partnership firm has normal tax liability 10 lakh, whereas AMT liability 15 lakh. Obviously, they have to pay higher of 10 lakh or 15 lakh. That is none other than 15 lakh. Okay, chalo. Friends, really, mentally, psychologically, physically, emotionally, devotionally, spiritually, you decided to pay 10 lakh. Correct now? But lawmaker asked you to pay 15 lakh. Means 5 lakh extra they asked you to pay. I repeat, everyone, please follow. You committed for the normal tax liability generally, that is 10 lakh, but department did some magic and asked you to pay AMT, that is 15 lakh. That means they forced you to pay 5 lakh extra. Don't worry, the 5 lakh I will give as a credit, that is called as AMT credit. Okay, chalo. If non-corporate SSEs, that means other than companies, paid tax as per AMT provisions, that means if they pay AMT, in our example that is 15 lakh, then AMT credit will be allowed. How much? Answer, how much you paid extra, that much only. That means AMT credit is equal AMT minus normal tax. In my illustration, AMT credit is equal 15 lakh minus, that is AMT 15 lakh minus normal tax is 10 lakh. So the AMT credit is nothing but 5 lakh. Okay, chalo. Next, student should get the doubt. When this MAT credit or AMT credit will be allowed? Answer, only the time when you pay tax as for MAT or as for AMT, then only AMT credit will be allowed. Okay, chalo. Next question. What is the fun of this AMT credit, or what is the use of this AMT credit? Answer: AMT credit you can carry forward for a period of, once upon a time, long ago, 15, that is 10 years. Nowadays it is for 15 years. You can set off and you can carry forward for a maximum period of 15 consecutive years. Okay, chalo. And what is the use? Such credit can be adjusted against tax payable as per the normal provisions. That means that credit can be set off in the year in which your regular tax liability is more than the AMT. Then only you can adjust. I will take one illustration, you can understood better. All of you, please follow. XYZ partnership form is there. The partnership form in the current assessment year, let us say 2021, their normal tax liability, let us say 10 lakh, their AMT liability, let us say 15 lakh. So obviously they have to pay 5 lakh extra. That means 15 lakh minus 10 lakh, 5 lakh extra I have paid. The 5 lakh will be treated as AMT credit. Okay, chalo. So when I paid tax as for AMT, obviously AMT credit also will be allowed. Such AMT credit I can carry forward for n number of years. No way. Maximum period of 15 years. Suppose in the year 2021-22, my normal tax liability, let us say 12 lakh, whereas my AMT liability, let us say 10 lakh. Thank God, right now I am in the normal tax bracket. That means 12 lakh. So whenever my normal tax liability is higher than the AMT, then I need to pay as for normal tax. So normal tax minus, now this AMT credit I can adjust. Okay, chalo. So that means in subsequent years, whatever the AMT credit you have earlier, that one can be carried forward and that can be utilized. Okay, chalo. How much we can utilize? Answer as follows. Quantum of credit. Answer: least of the following. I repeat, least of the following. Number 1, outstanding AMT credit. Total how much? Outstanding amount. Or else difference between normal income tax, that means regular income tax minus AMT. So in my earlier example, I have outstanding AMT credit, let us say 5 lakh. Okay, chalo. Difference between regular income tax as well as AMT. In my earlier example, regular income tax is 12 lakh, AMT is 10 lakh. That means the difference is 2 lakh. So whichever is lower? Tell me friends, 5 lakh or 2 lakh, whichever is lower? That is nothing but 2 lakh. So the 2 lakh credit can be adjusted. So your normal tax liability in the assessment year 21-22 is 12 lakh, minus you have to adjust AMT credit, that is 2 lakh. So net amount is 10 lakh is you have to pay as a tax. That means you can set off and you can adjust that AMT credit available with you. That AMT credit can be carried forward for a minimum period of 15 years and it can be adjusted in the year in which your normal tax liability is greater than the alternative minimum tax. How much you can adjust? Least of the following we can adjust. Number 1, outstanding AMT credit or difference between regular income tax minus AMT. So out of these two, whichever is lower only can be taken as a credit adjustment. So that means indirect meaning is as follows, friends. We need to pay something extra whenever my AMT is more. Okay, chalo. But that will be allowed as credit. So that can be given in subsequent period as a credit and you can pay less amount of tax in subsequent period. In the year in which your normal tax liability is greater than the AMT, that year this AMT credit can be adjusted. Okay, chalo. So this is the concept called as AMT and AMT credit. So AMT SSE can claim AMT credit in subsequent in the previous year even if AMT is not applicable in that previous year. So that means once you got the credit, it can be continued and you can set off even though that year you are not liable for AMT or you are not eligible to get AMT. So in that year also you can adjust and you can set off and you can continue. Chalo. And next one, other information. Tell me, advanced tax provisions are applicable or not? Now why I am asking specifically, now if your tax liability is more than 10,000, automatically you have to pay advanced tax. Suppose I am not liable to pay tax as for normal provisions, I am liable to pay tax as for the AMT. Am I liable to pay advanced tax? Yes. See the word, all other provisions of Income Tax Act are applicable. That means advanced tax also applicable even though you are liable to pay tax as for AMT, as well as interest under section 234B and C also applicable. Common sense ma, whenever advanced tax provisions are applicable to those SSEs who are subject to AMT, same way interest under section 234B and C also applicable. So all other normal provisions are applicable in case of SSEs who are come under the topic called as AMT. So that means advanced tax applicable as well as interest under section 234B and C applicable. Anyhow, interest under section 234A, anyhow that is linked with the that is filing of returns. Okay, chalo. But for your info, we need to obtain one copy from a chartered accountant. So SSE will obtain a report from chartered accountant who is in practice for computation of, that is total income, adjusted total income as well as AMT in form number 29C. Friends, in case of book profit computation, MAT computation, we need to take the form number 29B, whereas in case of AMT, adjusted total income computation, I need to take form number 29C from a chartered accountant. Okay, chalo. Next one, IFSC, okay, International Financial Service Centers. In this case, if your office is located in that area, your unit is located in that area, you must have pay the AMT at the rate of 9% instead of 18.5%. See the word, where the unit of SSE is located in IFSC. Now in this case the income is getting only in convertible foreign exchange, then AMT is payable at the rate of 9% instead of 18.5%. So